All right. So now that you understand how most investors are looking at deals the wrong way,
Let's actually walk you through a real scenario step by step.
and by the end of this video, you're going to see what a real deal actually looks like.
And we broke out the visuals for you guys. So let's get into it.
This is going to be pretty cool. So, what we're actually going to be getting into today, guys, is the real deal itself. The seller's name on this one was Tammy, and Tammy reached out to us through one of our marketing channels, and she was looking to sell one of her homes. And we're going to break down right now what this story looked like. So, this was actually Tammy's childhood home, which is pretty cool. Tammy's grandfather built this house in the 1940s. So, it was a one owner family home. You hear about one owner cars if you're a car guy, right? Like myself and like Jay, but this was a one owner home. That's awesome. Tammy's inherited this home from her grandparents, right? And Tammy did not want to be a landlord anymore. On top of that, Tammy was behind on her taxes and couldn't pay them up, and they had already liened the home. So she needed a quick option. But one thing that there was a kicker is that Tammy wanted to have some sort of connection with this property, and no other company was able to give that to her. So this is what we did. Jay, what we do with it?
We actually went the seller financing route with Tammy.
And what we did was Tammy had a purchase price in mind. Tammy wanted 300,000 for this house. And any normal cash investor was not able to give her that. The most that they were able to offer her was 225,000. But that's because they were looking at it from the old school method like we talked about in our last video of buy low, renovate and refinance. But because we have different tools in our toolbox, we were able to structure this differently. We gave Tammy her 300,000. We gave Tammy 15 grand down so that she can pay off some of her taxes and some credit cards from when she replaced the roof 2 to 3 years ago. On top of that, Tammy said, as long as you can do these things for me, I'm willing to give you a 10-year term with a 3% interest rate. And not only did we get a 10-year term, meaning we could pay her for 10 years on that 3% interest, but she also was willing to spread the loan out more than any bank ever would for 40 years to make our payment such a small amount. Now, going back to with this house, right? What did we do with it? So how do we maximize our profits? And this is what we talked about again in one of our prior videos is selling our homes on rent to own. This property, because of how we bought it, with the interest rate that we did, and because of how we sell it, we're gonna make $100,000 plus over a 5 year period on this one. So we collected a $15,000 down payment, meaning that we were able to get all of our money back without having to go through the BRRRR method, right? Our PITI on this, remember, was $1,500. We're renting it to our rent to own buyers for $2,500. Our net cash flow after vacancy reserves is clean in our pocket, $850 per month. We have no maintenance calls. We are not responsible for any utilities. And because of all of that, we have no reserves except for vacancy, which is our preference,
Yep.
right? So going back to the visuals, guys, right? We're going to break down this decision tree here for you.
So Mike just told you the story. He also told you the terms and exactly what we did with it. But how did we get there? That's what this video is about. So let's get into our decision tree.
This is what we run every single deal through as well.
Yep. So first and foremost, it's talking to the seller, not underwriting the deal. So that's why it's called seller diagnosis.
What does the seller actually want and need? We always need to start there. If you look at a deal from any other light, this is where you're going to go wrong. We asked Tammy the second question after she reached out to us is, why are you selling and what do you need?
Yep. This allows us not to get cornered, right? That is so important because with creative deals, we are not giving offers, right? We are letting the offers come to us. So, what does that mean?
So there's a lot of times this is what we're looking at, right? When that seller tells us their why and what they need from the sale of this home, that's going to be a clear indicator early on of what we could potentially do with it. If a seller tells us from the start that they need their money and they need it now, and that is non-negotiable because of a pressing matter, that means we're going to have to give them the old school cash offer. And that happens a lot, and that's okay. We still do that.
Now, if they express some type of need of relief, meaning they need relief of their payments, they can't make those payments, or relief of their tenants, right? They're not made to be landlords, right? They're not investors themselves. What does that look like? We are going to be offering them the possibility of terms, seller financing, subject to, wrap, or hybrid.
Now, lastly, if this is where it comes down to if a seller, maybe they're in a position where this is just a second home for them. They have flexibility on the deal. They just don't really want to make those payments, but they also have a good amount of equity, right? This is where we're going to also be able to offer them some sort of seller financing, right? Or a wraparound hybrid option.
And I know Mike keeps saying we're going to offer them, but essentially we will explore that option with them.
Yep.
I just want to reiterate that.
Yep. And when I say offer, and like Jay was just saying, I don't mean giving them a paper offer, right? I mean bringing up that scenario.
So after we look at these three sections, right, we're going to go into their equity position, and I'll show you exactly what that means.
So when we're looking at their equity position, this is going to tell us the type of creative financing we can do. In Tammy's situation, right? If we go back to it, we know that Tammy, she did not have a mortgage on her home. So that indicated to us first, right off the bat, this is going to be a seller financing structure. Now, if Tammy had a mortgage, maybe she just had refinanced and didn't have much equity, we were going to go the subject to route, meaning we're going to take over her payments and she's going to walk away. Now, there are a lot of times in certain markets around the country, Florida, Texas, just to name a couple, there's a lot of times these sellers owe more than their house is even worth at this point. And unfortunately, a lot of those times we have to walk away and we tell those sellers we're not the right buyers. Never overpay, even if it's creative financing.
Oh, I like that. I like that a lot, and we do say it a lot to our students. Never overpay. Get that through your brain. All right, let's go into the deal quality check, right? So we just checked the equity. Let's check the deal quality.
Now, when we're talking deal quality, we mean condition of the property, right? My goal and Jay's goal is to buy properties that need minimal to no renovation so that we could come in and have zero holding costs and the turnover process is extremely quick. Now, with Tammy's deal, Tammy did have a light reno that was needed,
Yep.
and that was okay because Tammy's house is in an amazing neighborhood in a prime location. They needed a kitchen, bath, flooring, paint, basics. That's where me and Jay will draw the line. And after that, we won't do any more. A lot of times with these heavy rehabs, you have to understand that they're heavy risk, right? And sometimes it kills the reward. Now, the in terms of the property condition, right? With with the deal that we had just now that we were working with, it would have been much easier if didn't need anything. But because it did, and because we bought it right, that was okay.
Now, that's not to say that with heavy rehabs, you can't do a creative financing solution. It's just we choose not to based on our exit strategy. So always keep that in mind too when you're doing this.
Now, this is one of the most important ones that we're about to get into now, and that's cash flow potential. If it does not cash flow as a long-term rental, we do not touch it, period.
See ya.
Don't even have to go through the yes or no. And then lastly is location. Tammy's deal, and I would love to go back to Tammy's deal because location is huge for Jay and I. We have done hundreds of creative deals, but did have not kept hundreds because we are so specific on location. Because when you have a great location, it is so easy to find a tenant buyer family with a big down payment. And Tammy's home was right in the middle of the Lehigh Valley in Pennsylvania, which is one of the hottest markets in the Northeast right now.
Yep. So always, always, always keep that in mind. So we've gone through the seller diagnosis, right? We've gone through the equity position and the deal quality check. Next is our famous Romans framework.
This is how we structure every single creative finance deal. So first and foremost, when we start up at the top, we're looking at the rate. For us, when we're looking at the rate, we're looking at, is it 0 to 3% can we get? And if it is, that means that's our target section. On top of that, if it goes up above 3, we cap it at 4% because what we've noticed, guys, and this is in the market all over every state, anything over a 4% interest rate with seller financing, unless you're getting really funky with the other terms, you start to not be able to cash flow anymore.
Yep, so Tammy was one of those sellers that was something that she was stickler about. She wanted interest rate, right?
Yep.
And typically we don't do interest rate like Mike said, but it's okay to do a 3, 4%. Don't go above that because why go above that when you're now in par with the banks?
And remember, we don't offer. So how did we get this 3% rate? I told Tammy, normally you know that we don't offer interest rates. So since we're not offering one, what's the least that you do? And she said, well, to be competitive, I'm okay at 3,
Yep.
right? And we let her offer us. The second is offer price, right? The price of the property. This is the least important lever in the entire framework, but always remember, guys, the other levers have to be in your favor if you're going to pay top dollar. After that is your monthly payment, right? Our job with these monthly payments, and we're going to talk specifically about seller financing where we can structure this lever the way that we want. Our goal is to structure this property and to structure these terms in a way where we're going to cash flow net in our pocket, minimum $500 in cash flow and or more, right? Now, when we come down to the amount down, right, our down payment, the goal is always no money down. That's always the goal. But a lot of times, especially in today's market and how things are going, sometimes that doesn't work for a seller. They have debts, they have other needs, they have issues that have come up to this point. For instance, Tammy, she had debts that were outstanding on the home. So if we gave her no money down, we still would have had to pay for them because she didn't have the money to. But the goal here is to get that down payment to be 5% or less of the entire purchase price. And as you remember, Tammy, she asked us actually, because I was going to say we didn't offer her. She asked for 15,000 to be able to pay off the debts.
Remember, you are a solution for these sellers, but not not entirely um giving them everything where it doesn't work for you, right? It's a give and take game. So, with Tammy, that was one of the levers that, hey, she was stuck at that 15.
So as you can see, right, and we're going to go through it at the end. For the rate, we took the rate. For the offer price, we gave her her price. For the monthly payment, we took that. For the amount down, we gave her that lever. Now, for the note length, this was one we definitely took.
This one was very interesting.
And the reason why, right? Tammy needed a certain price. Tammy needed a certain interest rate where we typically don't give interest rates. We still had a great one. But in order for it to cash flow that $500 a month or more net, we told Tammy our minimum balloon payment is 10 years. But at a 30-year amortization or where the loan is spread out over 30 years, we won't be able to make the money that we're hoping for because you're looking for that interest rate.
Wait for it. Here comes Mike's magic trick so that the monthly payment makes sense.
So we keep giving them what they want, interest rate, the price. What we need is that payment, that cash flow. We wanted that 10-year balloon and she was okay with it. So how do you get that payment to be lower? you spread the loan out further. So we did a 40-year amortization, meaning that we were able to spread the loan out past what normally banks would do. And that's the beauty of creative financing. So we took that lever. Now, start date, what we did with this, which was awesome, we actually inherited the tenants. So the what we did was is we negotiated with Tammy that once we closed on it, those tenants were going to stay in the home for about 2 months, which would offset and negate the payments that we had to pay Tammy. So technically, we we had 60 days until first payment. So we took that lever as well,
Bet you didn't know that one, did you?
which is
Yes,
awesome.
just like banks, we can negotiate when our first payment date is. If you recollect, when you get a loan from a normal financial institution, right, they typically give you anywhere from 30 to 45 days until your first payment. Same thing here. And a lot of people don't recognize that. So when you're doing Romans framework, remember that the S stands for that start date.
Coming down to exit strategy, right? This is where the money's made on the purchase, but there's also a ton of money made on the exit. We could have made money in every single way on this one, but what me and Jay looked at, and a lot of it had to do with the location, is where are we going to be the most profitable for the longest period of time, right? So, first and foremost, we always start at the top of our food chain, which is rent to own. Is this going to breed a good rent to own scenario? And the answer for Tammy's deal was yes. But what breeds a good rent to own scenario, right? And what do you get with rent to own? So, up front, you always get higher cash flow with rent to own. You have less reserves, meaning less expenses, and you can get higher than market rents. So higher revenue, lower expenses equals more profit, right? And on top of that, we get to BRRRR without the bank. So me and Jay, what we do is even if we have to put money down to the seller, we know we're going to get it back in a down payment. And that's how we keep washing our money, right? And keep paying able to pay ourselves back for any money that goes out on the street.
If you're sleeping on this strategy, wake up. Like,
100%.
seriously, wake up.
This is how most, if not all of the properties in our portfolio that we have bought with seller financing or creative financing and sold on lease options, we have an infinite cash on cash return, meaning we have no money left in those deals because of the rent to own exit.
Now, mind you, and this is a side note, rent to own gets this predatory outlook, but the way that we teach it, the way that we do it, is not predatory at all. So if you're interested in that, we can definitely do a video on that later on. Just
Yep.
leave us a comment and we can do that.
Absolutely. Now, second is long-term rental as a buy and hold. We also have long-term rentals, which not many people know about. We own properties in the city of Philadelphia that we do Section 8 rentals with for our own long-term wealth that we're eventually maybe passed down to our children, whatnot, because they're in up and coming areas. When we looked at this property, we said, look, we live about 3 hours from this property. On top of that, we may not be able to get the exact rents that we would want. And then after we calculate in reserves and maybe a management company, our cash flow was dwindled down to like $250 or $300 a month net. So that automatically took that exit strategy off the table for us, not because it wouldn't have been profitable and not because we don't want a big long term wealth. It doesn't fit our lifestyle and our model, and we invest for lifestyle.
Yep.
And then lastly is assignment, right? We had people crawling out of the woodwork to want to buy this property from us because of the terms, the location, the property itself. Everybody wanted it. And we probably could have made 15, 20, $25,000 assignment fee on this. But that would have been 25,000 one shot, and then that's it. So if you need quick money, or maybe your business is in a rut, that is always something to think about. But for us at this period in time, we needed it because of taxes. So we actually did something a little funky on the back end after purchase as well with this one to be able to lower our taxes. We're able to make over six figures over the course of 5 years with this property, not just a one time $20,000 fee. And on top of that, we're able to cash flow like a monster and not have to worry about the maintenance and repairs like a long-term rental.
So all in all, right? I want you to keep this rule of thumb, right? Open your toolbox and choose the best tool, aka exit, for profitability, right? Which tool is going to make you the most profit or aka easier, right, on the job? Keep that in mind. So,
Lastly, guys, we're going to get into the deal filter, right? So, as we were talking about, the goal for this video is for you to see a real deal, be able to know what the inner workings of the mechanisms are, and then on top of that, how to identify one quickly. And this is exactly what we give our team. And this is our buy box criteria. And this is the one that I suggest you follow, right? So up front, we're looking for 5% down or less. Secondly, we're looking for $500 a month in net cash flow or more. Then you're looking for 3% interest or less, 4% maybe if you have to, right? You're primarily looking for close to turnkey homes, so you do not have to come out of pocket on a big rental budget. And then lastly is 10-year term or more. In this market where it's so soft, especially if you're buying properties in markets like Florida or Texas, again, I keep naming those two, it's very, very important that you stick to that so that you don't get yourself in a pickle. And guys, when you're looking at these deals that are coming across your table, maybe you're even negotiating them now at this point. Can you confidently say that they hit these marks? If they do, I want you to move forward and I want you to get the signature. And Jay, if they don't, what do they need to do?
bye, Felicia.
Or restructure.
Sorry, I had to do that.
So now that you guys have seen, right, the Tammy story, the full breakdown, and you see our buy boxes.
But before we go there, Mike, I want to go back to Tammy's story quick. And I want to say that you really had, you know, a back and forth with her when structuring these deals. You didn't immediately come to this with her, right?
This was over a 6 month period. And I know Jay remembers this one as clear as day. We were in the parking lot of a grocery store when I negotiated this one for the last time for an hour and a half.
I was just gonna say.
Walking around the grocery store parking lot, going back and forth with Tammy. Tammy originally started off wanting cash at 280,000. Then what we finally came to the decision on is she eventually told me she wanted to be part of the deal somehow. And I said, "Look, Tammy, when I buy my properties, I'm the only owner with my wife. That's it. My wife's my only business partner on properties." And one thing that we came to an agreement on is that Tammy said, "Look, Mike, I also use this rental income to help pay my bills." And I said, "Tammy, I got the best idea for you." And this is where we came up with seller financing. Tammy wasn't an easy one, though. And if she's going to watch this, I guarantee she's probably laughing. And if you are watching this, Tammy, you gave me a run for my money. She originally wanted 40 grand down, $2,000 a month, 6% interest, 5-year term. And what we did was is we talked through it together and she explained to me why she was requesting some of those things, and then I explained to her why some of those things wouldn't work. And that's where we got into Roman's framework. And Tammy was asking for a lever. So every time Tammy asked for a lever, I had to explain to her that I do need to ask for one so it makes sense. And by the end, we hugged it out. Legitimately, we did,
Yep.
right? On that porch, we all gave each other a big hug and we solidified it and we made the deal happen.
And one thing that came out of that conversation that I want to point out is the fact that Tammy wanted to stay in the deal because that income helped her, but also there was an emotional attachment to the house. This house was built by her family.
Yep.
She wanted to somehow still be a part of it emotionally. So that was huge on her part, which is why Mike was able to calmly build that rapport with her, give her explanations, and move those levers like he said.
Yep. Like we had originally talked about, as we go back to what we said originally, right? At the beginning, this deal this style of property and purchase is not what most people are talking about in terms of creative finance. Very few people actually know how to structure this stuff right now.
And hopefully now you can see it's not about finding better deals, it's about seeing them entirely different.
And if you are looking at deals right now,
And you're not sure what works and what doesn't,
I want you to apply for a strategy session below. And in the next video,
we're going to break down something that most investors completely misunderstand
that's what sellers actually want and what sellers actually need.
and why it's almost never the price.
Because if you can understand that,
That's when structuring deals like this, like we just showed you, becomes so much more easier.
and honestly, that's the piece most investors are missing. See
See
you
you
in
in
the
the
next
next
one.
one. Disclaimer: this content is provided for educational and informational purposes only. The views and strategies discussed are based on personal experiences and do not guarantee specific results. Real estate investing involves risk, and each individual's financial situation is unique. Always perform your own due diligence and consider professional advice tailored to your circumstances before making investment decisions. This is not a solicitation to attract investors, nor are we marketing any securities. Neither the hosts nor guests assume liability for any outcomes associated with the information provided.